Excellent. Okay, well, thanks very much for inviting me. I hope you had a super duper conference up till now, and I'll try and keep the quality going. So what are we going to talk about? First of all, I'm going to make a presentation on the hotel market in West Africa, both existing and the pipeline, focusing on four main markets. No surprise what they four are. It's going to be Lagos, Accra, Abidjan, and Dakar, the four biggest in the region. Those of you who don't know me, Trevor Ward, I'm a consultant, been based in Lagos, Nigeria forever. Well, it seems like that anyway, nearly 20 years, studying and advising on the hotel industry everywhere in sub-Saharan Africa, but with because of where I'm based, a clear focus in Nigeria and elsewhere in West Africa. Very active currently in Nigeria and in Ghana. So some macro background first of all to make a point about the difference between Francophone West Africa and Anglophone West Africa. So there you have at the top the two countries I'm focusing on: Côte d'Ivoire, Abidjan, the commercial capital; Senegal, Dakar, the capital; Ghana, Accra, Nigeria. I'm actually focusing on Lagos rather than Abuja, but these are exchange rates for the national currency. The CFA, the CFA, up the top, is that used in most Francophone countries in West Africa. I say most because, for example, Guinea has its own franc. It is not part of CFA. Now the CFA is actually pegged to the euro. I'm often pedantic when I say that because it's actually pegged to the euro at the rate that the French franc went in. So what you can see from this is that there's been a relative stability on the CFA throughout this period, through the last decade. It's been very, very stable, and any wobbles there are actually the difference between the US dollar and the euro. But even so, it's been pretty stable compared to. I've got an awful lot of background noise from somebody. I don't know if it can be stopped. Beautiful, thank you so much. The Ghanaian cedi. Now, the Ghanaian cedi was issued at par to the US dollar in 2007. They locked off 4 noughts from what they were using in, I think they call it CD2. This is CD3. And you can see that over the period, it was nearly 2 at 2007. And today it's trading at about 6. Now, the Naira, the Naira was issued at 2 Naira to the British pound in 1973. Now it's trading at an official exchange rate of 380. But that is not the rate that most people can buy dollars at. The rate is more like 440 or more. It is a floating rate. That is the fixed CBN rate. You can see that what the Naira does is very, very stable. Ups again, stability, and then up again quite recently. What is going to be in the future is someone more clever than me can determine or speculate on. What is the relevance of this? Is that if you want to import materials for building a hotel or materials for operating a hotel, you have pretty much certainty on your exchange rate in Francophone Africa. You do not have that certainty where in Ghana and Nigeria, the price of imports in local currency is much, much higher than it was back here. And that has an impact on hotel operations and development. as I'm sure we'll discuss shortly. The other macro one I want to look at is interest rates. Now, again, you see the CEFA is pegged to the euro, and therefore the policy regarding interest rates is actually more decided in Paris than it is in Abidjan or Dakar. Now, I know that's changed, but it's very, very recently. They changed to the ECU, and there will be more control in the West African users of that currency. Ghana, if you look at the trend lines of those four, they're pretty similar. In other words, interest rates have increased over the period of here 2011 onwards, the decade. But look at the quantum of interest rates that in Côte d'Ivoire and Senegal, the same, because we're looking at 4% interest rates typical to the euro. In Ghana, if you want to borrow locally in local currency, the official rate is 20. In Nigeria, the official rate is about 15. But I can assure you that borrowing money in local currency in either of those countries is much, much more expensive than the rates shown here, 20 and 15. It is also very, very short term. And that clearly has an impact on developers of hotels. Now, moving on to the hotel industry, those are two macro factors which impact on operations and development. This is existing branded supply rooms in the four cities. So we have the top here is Lagos, and then the red one there, Accra, Dakar grey, and Abidjan blue. Not a huge increase in Dakar, Accra, and Abidjan, but there has been an increase since we have snapshots available at 2014, 2017, and 2020. You can imagine that measuring this is a never-ending data collection exercise, but we did it 6 years ago, 3 years ago, and very recently. Oh, you're going to say, what's going on in Lagos? This mega city, reported to be the biggest city in Africa and one of the biggest cities in the world. What happened? Well, I can tell you what happened, that we lost two very, very large branded hotels in about 2018, 2019. They were the Festac with 300 odd rooms and the Intercontinental with 300 odd rooms. Neither of them are now branded. Festival Festac Hotel and the Lagos Continental, and then a couple of Proteas fell out of the portfolio after Marriott's takeover. So we've gone in Lagos from about 23 branded hotels to about 18 over that period. More are under development, but it's very interesting to see how, at least in Nigeria, just because you're branded doesn't mean you'll be branded in 3 years' time. There has been quite an unusual shift. Now going to the pipeline, to explain our pipeline, what we do every year in January, February is we collect data from the chains themselves. These are branded number of rooms. We collect the data and we analyze that data as provided to us. So we don't change anything because we think it should be changed. We analyze that data as it is. And we publish an annual survey on our website. I hope it's working today. It wasn't yesterday. You can actually download your complimentary copy of the 2020 pipeline survey. Remember that the data were collected in January, February, before our world changed so much. 2021 may or may not be another story, but I'll show you some of the impacts on what's happened this year on the 2020 pipeline. much bigger pipeline in Lagos, as you'd expect, because the city is so much bigger. A general increase on the trend lines on the other three cities. You're going to ask, why did this go down? This decrease here was because the Intercontinental Hotel opened as a branded Intercontinental Hotel. Very large hotel opened, and therefore the pipeline went down. But a huge in the numbers here. And then some hotels were opening, some small hotels were opening. And then another dip here because the chains looked at their pipelines across Africa and decided that many of the hotels were never going to happen. And that's why there was a dip in the pipeline there, plus an opening in Lagos last year. I bet you're also looking at the green line. Why was there such a reduction there? The answer there was that in the pipeline here, we had Azalea Hotels, we had the Scene Hotel, and they both opened, therefore the pipeline dropped. But we also had the Sofitel Hotel, which was opening and closing hotel rooms for renovation. So that explains part of that, but a terrific recovery in the Abidjan pipeline after that dip. So moving on to when we were initially briefed on this session, we were asked to look at another macroeconomic factor, which is the epidemics which have impacted the region or the world, or the sub-region or the world. And so we plotted here in 2014, Ebola hit 3 countries in West Africa with a ripple effect all over the continent, even down to South Africa, which was a very, very long way away from the epicenter. We then looked at the Middle East virus back in 2015. And of course, today we have had COVID-19. I think it's fair to say that there's no attributable impact on deals being signed by the chains with owners and promoters. We had demand fell very severely in 2014, but that wasn't long-lived, and this is, of course, looking at supply. So there was no impact on deals attributable to that. 2020, COVID-19, we won't know the impact on the pipeline on deals signed until next year to see what's happening with these data points here. But what we have done is we've looked at the 2020 projected openings. Now this means that at the beginning of the year, the chains told us that so many hotels would open in 2020. They believed that that was in their schedule, their planning to do so. And it comes to, I think 91 is, or 92 is the total number of hotels that the chain said were going to open in 2020. Now, these are a bit too small to analyze here. So, but if we look at all Africa, and what we did is we went back in September and we said to the chains, this is what you told us in January. What is the position now with those openings in 2020? Already 18 or 19 had opened when we polled the chains in September. Another 20 odd, the chain said, yeah, we still believe that those hotels will open in 2020. And in fact, one of them, the September, Radisson told us that, yes, we will open the Johannesburg Radisson Conference Center. So, and indeed, that did open in that period. So we can now add that to the blue line. It opened, it did happen, despite everything going on in the world. 4 hotels in grey, we actually couldn't find any information about them. But what we do have here is this 50 odd hotels, or just under 50 hotels, where the chains have said no. We thought they were going to open in 2020, but they are not going to open in 2020. Some of them stuck their neck out and said, we'll open this year. Others just said, no, we won't open in 2020. And I think it's inevitable that some of those hotels in the brown, they won't open in 2020. So they will be pushed into this bar. If you look at the history, though, so what we're saying here is that 50 to 60% of the pipeline that was supposed to open in 2020, it ain't going to happen. So the realization rate, actualization rate, will be maybe 40 to 50% of the hotels that were supposed to open. Is that because of COVID-19? Certainly for some of these, definitely. But we can't say categorically the reason for each and every one of them. You'd need to look at individual deals. Just to put it into perspective, so we're saying, let's say 50% to be generous in 2020. The actualization rate last year was 75%. 75% of hotels that they told us would open in 2019 actually did open. 2018, it was a miserable 39%. 2017, it was 54%. So it's not that bad, really, compared to the history. Going forward, this is the annual rooms that we were told were going to open in West Africa at the beginning of the year. And I just put the cumulative there. That doesn't reflect the actualization. 2021, this is then cumulative, so adding the blues up as well, just to show you the activity that's there in the West Africa pipe in the future. But if we go ahead, there's 22,000 rooms. And virtually every country in West Africa is in that 22,000 rooms, scheduled, promised, anticipated to open in the years in future. Is it wishful thinking, some of it? Absolutely. If I look at the detail behind 2021 and 22, there's no way that this will be actualized. But that's another story for the future. Going down into the four cities. Now, this is the data from the beginning of the year. This does not include any of those hotels which are pushed out from 2020 into, say, 2021. These are the projected openings, rooms per city by year. Abidjan, we have an Adagio and a Novotel coming in from Accor. Mangalis have two Yas hotels due to open. Radisson have 2 hotels due to open. That's a Radisson Red and a Radisson. Accra, there's a couple of Pullmans slated to open in 2021, Accor brands. A Hilton and a Hilton Garden Inn there in the yellow, and a Radisson Blue, which is definitely not going to happen. Dakar, we have a Hyatt and another Yas from Mangalis, a Mervynpick and a Scene in 2022. And then here in Lagos, we have another Pullman on the books, a Marriott and a Radisson Collection. But the Marriott it's getting there. It's pretty ready to open. I mean, that could open if the owners decided that they will open. And then in 22 in Lagos, an M Gallery, a Novotel, and a Hyatt. I don't believe that all of them will actually happen. Finally, we have 2 panelists. We have Ramsey from Radisson, and we have Andrew from Hilton. What I've done here is if I've analyzed their pipelines as they reported to me compared to their actual number of hotels. So the blue is the rooms that Radisson were operating back in 2013, very few, below 500, I think. And then we're up here to over 1,500. So interesting progression there of opening rooms. Beginning here, they had an increase in the pipeline, then a plateau, then an increase in the pipeline, and then a decrease. But don't forget, of course, that a decrease in the pipeline is actually more reflected in openings than in anything else. So, but what you can see is that these two lines seem to be coming together. So I'm sure Ramsey has this slide, and I'm sure he's going to comment on what's going on here. By the way, this is the whole of West Africa, not the 4 cities. Now, looking at Hilton, same analysis. That you see on the blue line there, we have, it's a plateau, isn't it? Here, those in the savvy about Hilton will know that this was one hotel. A lot of rooms up there in Abuja. And then I think Chad opened. And then a small hotel in Lagos opened, and then we're plateaued. Now on their pipeline, Hilton pipeline, what an amazing push they made, basically because they opened a development office in Cape Town. And you had people on the ground who signed and signed and signed and signed and signed and signed and signed, and then found it more difficult to sign, had another bit of a thrust, and then we'll call that hotel's opening. So that's the end of my presentation. I'm now going to go to our two panelists, ask them to talk to what I've been presenting, which is their own pipelines, which is the difference between Francophone and Anglophone Africa, the impact of exchange rates, the impact of interest rates, their experiences basically on operating and expanding in West Africa. So I believe I need to go stop sharing. Is that right? Are we in good shape now to be looking at the panelists?
We are.
I see Andrew, fresh from the gym.
I'm fresh. Fresh from Safari. I've just been looking at some Safari lodges. So just got to the airport and connected.
Fresh from Safari.
Yeah.
Oh, what a lovely traveller he is. Okay. Ramsey, so Andrew, where are you today? Johannesburg?
I'm in Johannesburg.
No, I'm
Johannesburg.
in Dubai, so I'm based in the head office.
Right. Okay. Looks like a gym behind you.
It's the office. I was in Cape Town last week, but this week is in Dubai. So the good thing
you were in Cape Town. You're in Dubai.
The good thing
to
see is,
again, I got some horrible. I got some really horrible background noise. Andrew, is that you with the lions you brought back from Safari?
Yeah.
Oh, who's that?
It's Andrew. I've got the lions on Safari in OR Tambo Airport, so it's a bit noisy. I'm connecting back to Cape Town. I'm in the airport, so quite a noisy.
Oh, he's just showing off what a traveller he is. Isn't that wonderful?
Yeah, but I think it's a positive news if you look at it, Trevor, because I think it shows that slowly borders are opening, people are starting to travel back. I think we're also examples of business travel ourselves. So I think it's certainly a positive testimony to see Andrew traveling and myself last week. So I think we should be pleased about that.
So you're not locked down, obviously.
No longer.
No. Okay. I spoke to another chain last week who will remain nameless, and they said no, we're not allowed to travel yet. So anyway, Ramsey, talk to me about the difference between what that you find in Radisson between Francophone West Africa and Anglophone West Africa?
Yeah, I mean, I think, look, the dynamic you probably demonstrated well was the correlation of interest rate, but also, the stability of exchange rate. That I think is, defining what will be the construction cost. And when you look at it, obviously, we can see Nigeria probably facing one of the highest development costs across the continent, if not even globally. While, in other countries, I think the ease of buying in hard currencies and the access to dollars because of, more of a pegged rate has more ability to probably, manage at least or know what will be the construction costs. I mean, for us, I think Nigeria remained probably one of the, main focus country in West Africa. Having said so, I think, Senegal and Ivory Coast are two main economies in West Africa, which, will be probably, again, for us, a plan of action in terms of growth and priorities, being Abidjan or Dakar, but even surrounding, economic cities, but even resort destination. So for us, I think it's a balance between the two, but everyone has been speaking about Nigeria because, as you mentioned rightly, is one of the largest country and certainly probably coming up one of the largest economy also moving forward beyond Africa. So I think, yes, there is a lot of attention. For us, we're mainly present in Lagos today. I think Abuja, we have development plan, but I think we would want to see, a property in operation soon enough. And that's the main intention.
Okay, but are you saying it's mostly the exchange rate that affects?
Well, I mean, I think
affection?
It's affection. No, I would say if we take the example of Nigeria, I think because of the exchange rate, yes, that has the biggest impact on our fees, the ability, obviously, to mitigate the risk on the development costs, but also the ability to take foreign currency out of the country, which you will have more implication in Nigeria or English speaking that you would have in French speaking, where there is less foreign exchange restriction because of the PEG CFA. So I think that has a dramatic impact on operation on one side, but also has an impact, as I mentioned to you, on the development costs. And that is because you have less visibility as the currency is fluctuating over time. And we see this now, especially with COVID, especially when we see, Nigeria as a country in relation to oil and gas economy. And that will create even further, implication of growth of interest rate or cost of borrowing in local currency. So, the ability of borrowing in dollars and English speaking, as you rightly said, is more complicated than it may be in French speaking. And that creates a dynamic that is different. But again, the economies are not the same. And I think what we don't mention today in West Africa on the French speaking side is that there is also, a lot of change on the political environment, the change of, of government and leadership. And that has also an impact in the cycle of, growth and development.
Andrew, you perhaps stomped around the region a bit more than Ramzy. I've known you in West Africa for a very long time. What's your take on this? I'm sure. I know you have been active, very active in all the countries. Are you checking in again, Andrew?
No. So I think from if I look at Hilton's activity right now, we have more activity in Francophone West Africa than we do in Anglophone West Africa, and that's quite an important focus for Hilton at the moment because we actually don't have anything open and trading in Francophone West Africa, and it's important for us to get our brands open and in Dakar, in Abidjan, and in some of the other Francophone sort of gateway cities. So during COVID,
you did have a hotel in N'Djamena, which I included in those slides correct. In Chad.
Yeah. That's right.
But I did not include Cameroon. Of course, you have a hotel in Yaoundé.
Yes.
But is that because there are more interesting regions and you can only spread yourself so thinly? Or
no, I think for us we've got a very specific focus on sort of getting our brands present in Francophone West Africa because we don't have a presence at the moment. I think the access to funding is a little bit easier because the CFA is pegged to the euro. The market is not as oversupplied or as competitive as the Anglophone markets. So the Francophone markets have really been owned by Accor for a long time. And obviously Radisson has come in and has been successful in the Francophone markets. But there's space for Hilton and our brands to also be in those to be in those markets. So it's an important focus for us. I think that there's you're not having to, when you're looking at funding properties, you're not having to worry, am I doing a dollar fund or am I doing a local currency fund? And because as soon as you're doing local currency, if you're looking about Nigeria with an interest rate, your payback terms are, it's almost impossible to fund a property in Naira. So the funding of the packages is a little bit different, and we're finding that the owner class is a little bit different in the francophone markets. Doesn't mean that we're ignoring the anglophone markets. We've been present, as you highlighted in your slide. We have a massive Hilton in Abuja that opened in 1987. So we've been in Nigeria for a long time. Interestingly enough, we're working on a number of exciting opportunities in Nigeria, bringing in more brands into the market and leveraging off the success of our long-standing experience in Nigeria. We've got two properties under development in Accra, which are the one we hope to open in 2021. So there's a lot of activity for us in West Africa.
It does occur to me, and I'm not going to name names, but Hilton has had I won't call it a bad pipeline because that's a different concept, but Hilton's history in, say, Nigeria, particularly in Lagos, where in the old days, if you mentioned Lagos Airport to Hilton, they would run a mile because they'd had so many deals fall apart. But it does seem to me that Hilton have probably more than any other country, certainly in West Africa, you've had deals which you've had to cancel because of non-performance by the owner. They just haven't gone on site. Is that a feature of the Nigerian environment? Because I don't think that's happened much elsewhere, has it?
No, I think all hotel companies would clean up your pipelines at stages. Every year we'll have a look at our pipeline and make sure that the deals we've signed are actually active. So I don't think anybody intentionally, when you enter into a deal, doesn't believe that you're going to be able to deliver a hotel project. So no owner spends the time and energy designing a hotel, costing a hotel, and signing it with Hilton or with anybody else with the intention of non-performance. And then there's changes, things change, focus changes, and sometimes the hotel doesn't actually materialize. I think there's sometimes due diligence issues which could have been done a little bit better, which we've obviously fixed to make sure that when you do go and sign a deal now, you've got a high probability of the hotel opening once it's actually signed. So at the moment, I think that's
Ramsey. Go on, Andrew. Sorry, finish.
So I think at the moment, because of COVID, a lot of banks are looking at how they're structuring debt, and they're having to protect some of their existing assets. So I think we've definitely had hotels in our pipeline that have been moved out. So we take the Hilton in Sierra Leone; it's been moved out by 12 months, and that's primarily because of COVID. That the design and build contractor, which was getting most of his product from India and from China, has not been able to actually manufacture and actually ship it, and so that's at a fundamental month delay because of that. There's other circumstances where the banks are saying we need to relook at the funding structure because we've got X amount of debt sitting on existing stuff that we now need to refinance. So definitely, COVID has definitely caused some havoc in some of the pipeline projects for sure.
Right. Okay. Well, very interesting, Ramsey. I don't for 1 minute suggest that this is Radisson, but I do remember from another hotel chain who kind of deliberately built a bad pipeline because they say, well, this was relating to Africa, and they said, Trevor, well, if we sign 10 deals, we might get one of them built. Really? Tell us about your attitude to volumes, and you can say that that's not us, of course, but also when your shareholders or your bosses or your owners look at that graph which I put up there, the second to last graph, where you see room numbers increasing. I'm not sure if that's the right way round, but anyway, room numbers increasing, and the pipeline not actually increasing very much. Now, where does the importance lie? Is it open rooms that you get patted on the back for, or is it volume or pipeline?
No, I think, look, more than ever, and I think, look, you mentioned it yourself. I think net what we call net openings, and that's truly openings after even wash out of existing hotels. So we're going even one step forward. It's not just looking at opening existing, but it's retaining the existing hotels that are currently trading. And I think the graph that you showed it, at some, accuracy of some hotels maybe missing in West Africa as we define it, is showing, a growth of openings. And that is the most important. Now, as you mentioned, as Andrew mentioned, I think that's the dilemma of Africa. And the dilemma of Africa is certainly on the funding. And that's across, and I think West Africa more than ever. And that funding creates erosion. And I think this is the risk. Now, are we looking at, continuing that risk and continuing in volume for as you say, a smaller percentage of success? No, not at all. I think today, what we're all taking as a step forward is having much more due diligence. And that due diligence is ensuring, quality of partnership, having the right, background check and the right funding in place. And now we're not in, I think, it's the curve of any story. And I think any chain in growth has certainly at times, accelerated faster than they should have. And I think today we have reached the scale that we feel comfortable in Africa in terms of ensuring that we take a really diligent approach. And that growth now is, yes, we're not in a position to sign unless we see all, the criteria being, checklisted. And that is funding, that is the right partner, that is the right professional team, the right location, and the right project. And that is to minimize the risk of erosion, as you mentioned yourself. So for us, that graph is certainly, a recognition of what has been done previously, and that we can certainly give credit also to Andrew today, and that is achieving openings. And I think openings is certainly the only factor of success, and nothing else can it be.
I totally agree with one proviso, which I'll come back to, but it's a fact that Hilton have not been able to as many hotels or even rooms as Radisson. It's a very interesting graph there. The one proviso which I would throw in here is that I read a lot of analysts' research. When I say analysts, I mean from City of London, from New York, from Paris, about quoted stocks. So we're talking of Hilton as a quoted stock, Marriott, Wyndham, not Radisson, because you're not a quoted stock. But they do put actually a lot of weight on the value of your pipeline, because that is a forward value which they can factor into a share price. That's why I'm thinking how much pressure you're getting on keeping that pipeline number up. You're a quoted stock, Andrew. I know kind of the share quote is way above your head or your pay grade, but the pressure on you to keep the pipeline numbers up.
No, it's just my role is to open hotels, not to sign deals. So we're going to drive shareholder value in the fees we earn, and so we need to open. We need to have the right brands in the right locations that are affordable. Let's have the best chance of opening. So we've got more brands available to Africa today, so that we can actually maybe not put a square peg into a round hole and have the right brand in the right location at the right price. So it gives everybody the best possible chance to actually have that hotel open. So it's right. So I'm measured, and my team is measured on hotel openings. Actually, the entire team, from an operations point of view through to architecture, design, and construction, is measured on hotel openings. And there's Africa's a tough market, right, and we've got a lot of work to do. And we've got to, as Ramsey said, you got to make sure that you've got the best possible professional team, that the best contractor. You've got a bank that understands hotels and understands the cycles in hotels. And so right now is actually the right time to be looking at new hotels. We're at the bottom of the cycle. You're able to contract at lower construction prices than you normally would be able to. You'll be able to negotiate better professional fees than you normally would, because people are desperate for business. You're able to, if you're going to acquire land, you're able to acquire land at a discounted price right now. So if you believe in the long-term future of that city and that location, this is the right time to be looking at new opportunities. Again, must be the right brand in the right.
Well, okay, let's talk about locations. I'm tempted to try and find the slide, but I'll probably fall over the IT if I try and share again. So Ramsey, let's start with Radisson, Radisson Hotel Group and Lagos. 1, 2, 3, 4 hotels currently in Lagos. You were very fortunate to be able to secure a 3-hotel portfolio. Couple of years ago, was it? Yeah, early to in 2018. So you've got 4 hotels in that city. Without revealing any confidences, what are your plans for Lagos? How do you see that mega city, 20-something million people, 5th or 6th largest GDP in Africa? It depends entirely on how you count, how you count the GDP. Very diverse, very dynamic city. Lagos, where does that appear on your priority list?
And it's still number one, as I mentioned to you, as we look at Nigeria, and we still look at Lagos the same way. I think what is the opportunity for us is the diversification of brands. I think Andrew was mentioning the same in terms of having an ability to provide different brands at different locations, and that includes Lagos. I think today we have obviously from Radisson Blu to Radisson, but also we have the ability to do service apartment to business hotel. And I think that ability to diversify from, mid-scale to luxury, even moving forward, is certainly the approach. We have other projects in Lagos under construction, and that shows you, again, the commitment we have to the city. But I think, yes, is that flexibility of finding the right product in different location of the city. The city is large enough to cover and capture different segmentation, but also the product differentiation from a price point, positioning, but also a value offering, as I mentioned to you, from mid-scale to, again, city hotels or even service apartment, which as a side note, we've seen being extremely successful. On the story of Lagos itself, to the surprise of everyone, actually, the properties that we have in the portfolio that you mentioned have been able to outperform the market. We have been remained open during the whole COVID-19. I think, if we look at year-to-date performance of the properties we have in Lagos, we were in excess of 75% in occupancy, and obviously very profitable GOP. And that shows you that we were able to substitute. Obviously, the market that we were capturing during this time was a market that was created because of COVID. That was a quarantine business. That was the isolation of, telecenter conference calls. So we were able, proactively and commercially to find substitute demand. But again, showing you the resilience of Lagos even as a city.
Yeah, sure. And I know you've announced 2 Radisson Collection hotels. Interesting. They're not a million miles apart. And so one may open next year. The other, it's difficult to say. It's under construction, actively under construction. So 2 Radisson Collection luxury hotels. Sticking with you, Ramsey, on Anglophone for the moment, talk to us about you and Accra.
Yeah, look, Accra, we don't have anything yet in terms of operation, but we certainly have a project under construction. I think, because of COVID and the uncertainty, I think Ghana has been a difficult market for us to enter. As you stated before, we used to have a project which never materialized. I think we haven't been able to find, and that's the indication of finding the right partner and the right, team overall with everyone that is into play.
Right.
So I think that's where we stand now.
The nuts and bolts.
Correct. But I think, another, strategy that I think is being pushed forward as a priority for us across English speaking, but across West Africa and Africa in general, is the launch of the new brand that we announced last month. And that is a conversion friendly brand, which is, an affiliation. And I think that is something that we certainly want to push, in some of those key capital cities. And that is inclusive of Accra itself, but also of Lagos, Abuja, and tomorrow in Abidjan or Dakar or elsewhere, being also Cameroon or Niger or the countries in West Africa.
Any signs of life in that the exchange project, the one near the airport, Radisson Blu, seems to have been stalled for several years now. Any signs of life?
No signs of life. And again, I think it's part of the responsibility every other time to look at project and seeing if there is, as you say, a likelihood of materialization. If not, then we take the responsibility of terminating those agreements and moving forward, and that's what we've been doing.
Yeah. Okay, Andrew, to you on Anglophone, your opinion of Hilton as a destination for Hilton brands, and also Accra. I'm going to give a little bit of background, some of which you may or may not know, Andrew. Hilton actually opened a hotel in Lagos, probably in the 1970s. And they even had their own road. It's on Hilton Avenue. It's up in Ikeja. I don't know whether that hotel's still there, but it was never, of course, an official Hilton hotel. And I remember going there maybe 20 years ago, and it was broken glass in the windows, shower curtains on the floor. It was the usual, you know what I mean. So joking aside, ever since then, Hilton's really struggled to get a presence in that huge, amazing city until 2 years ago when you opened the Curio. So this is a soft brand on a beautiful hotel, the Legend Hotel up at the airport. The only hotel that I'm aware of, certainly in Africa, in a free zone. And it's actually airside. So you can go into it's half airside, half landside. So you can actually go into the hotel, and there is the passport control and customs in the hotel itself. It's a wonderful hotel. You can sit and have your breakfast watching the executive jets move around. So it's been a struggle, hasn't it, Andrew, to crack Lagos?
Yes.
Talk to us about Lagos.
So Lagos is a key city for us. We would like to have a big box Hilton in Lagos like we do in Abuja. So that would be the ideal sort of scenario to dovetail with the Hilton Abuja with a big Hilton in Lagos. And I think if we're looking at the opportunities in Lagos, we really see Lagos having the opportunity for conversions and new builds and adaptive sort of reuse. So I think we have the ability and we have the brand flexibility and the commercial mindset to look at hotel conversions. So if we come across the right hotel that we think can be converted to one of our brands, we're open to the ability to look at a conversion, because of the risk of new build. New build in Lagos and in Nigeria typically takes a long time and is quite expensive. And then obviously we would look at sort of adapted sort of reuse. And the best example of that would be if I had to jump into Accra, where it's looking at an existing structure. So if you take the Hilton Accra City Centre, which is an adaptive reuse of apartments which are now being converted, an apartment structure which is being converted into a hotel structure. But we see both Accra and Lagos having the ability to probably have at least 5 of our 12 brands we have active in Africa in those cities, really starting from sort of Hampton by Hilton in the entry level sort of 3-star to a Hilton Garden Inn to a DoubleTree, a fully fledged Hilton. And we also think that the extended stay product and demand is important. So we've brought Embassy Suites by Hilton to Africa, and we actually have opportunities in both those cities at the moment where we investigating the extended stay product with an Embassy Suites by Hilton. So we think that those are really the 5 brands you would like to have in 5 very, very clear market segments in those cities. And then we have the ability with our 3 collection brands that can be soft brands like the Legend in Lagos, which is a Curio collection. So we've got Tapestry collection, which we could look as a soft brand if we're doing a conversion of a well-known hotel that's within the correct sort of market segment. So, but yeah, no, Lagos is a hard market, but we're working hard. I'll be there next week, so to arm wrestle and try and move things along.
Right. Okay. Interesting soft brands. Ramsey, we mentioned that you have 2 hotels opening under a soft brand, which is the Ramsey, the Radisson Collection. You've got the Chelsea, isn't it? The Chelsea Hotel, a Radisson Collection, and you've got the Emerald, I believe it is, a Radisson Collection. So as yet, you don't quite know what the market's going to think about a soft brand. But Andrew, you've now launched a soft brand. You have the legend, a Curio. So we don't really do soft brands in Africa very much, do we? You're probably a pioneer. How has the market taken to Curio?
So
the Hilton is tiny, isn't it?
It's interesting. So that performs really well, and we have a lot of interest for the Curio brands elsewhere in West Africa, and a lot of our customers, obviously through Hilton Honors, understand our brand portfolio and understand that it's Hilton's behind the Curio brand. So we as a brand itself, it's had quite a lot of penetration in the marketplace, and that's why we actually have brought Tapestry one category down into Africa as well, because we think that we can actually have a soft brand in the upscale segment and a soft brand in the upper upscale segment of the market, both obviously backed by the Hilton system, but giving the owner the ability to keep their own brand identity. And I think as travelers and the market has changed, people are wanting individuality a little bit more, and they're wanting sort of individual experiences. So we have the ability to either offer a hard brand or a soft brand, really. So in the upscale segment, we could talk about a DoubleTree by Hilton or a Tapestry Collection by Hilton, and obviously in the upper upscale, it would be a Hilton hotel or a collection.
All right. Well, we're running out of time, but just on that, Ramsey, you probably got experience of the soft brands in the Middle East. The market takes the soft brands very well in a not immature market, but you know what I mean. They're not Germany. They're not the States.
Yeah. Look, I think the fundamentals is the number one is location, and we always say that. Now, if we take the analogy that you had in Ikoyi, the Chelsea is actually on a core brand of Radisson Collection, so which is what you call the Chelsea is Radisson Collection Ikoyi Lagos. So that is a core brand Radisson Collection. Well, what we have done on the soft brand is only on the Emerald that you mentioned, which is then a Radisson Collection hotel. I think it depends. I mean, commercially it's still the same tools, still the same distribution, but what is truly putting forward, I think, is the identity and somehow this kind of authentic experience from a design bespoke. So that gives you also the flexibility to provide a concept which is not standardized, doesn't have the same look and feel of any location, but truly, fits and has the merit of its own destination. And I think that's what we've been doing with Radisson Collection. But Radisson Collection has been truly a testimony for us to be able to enter, what Radisson Blu wasn't being able to achieve. And this is really something above the 5-star Radisson Blu. And that's where Radisson Collection sits. I think Lagos has the ability, because of the pricing of the market and the price point that you can see in, call it the luxury or entry-level luxury segment. And that's why we want to enter. And I think that's what the differentiation of the launch of Radisson Collection in Lagos for us was. But what we have recently launched is, a much more softer brand, if I want to call it this way, with Radisson Individual. And that is coming in a much lower segmentation in terms of positioning. And that is truly a soft brand. And brand is truly an affiliation. So that is really giving support into existing operation, existing hotels, which have their own identity, but also their own management. And that is purely giving an access to the network of Radisson. And I think leveraging on that. And I think, yes, do people unique experience? I think, yes, you spoke about the Middle East, but I think even us as consumers, we see that.
Thanks, Ramsey. Sorry, we're getting out of time, but I do have one last question for you. If you can just keep it to 30 seconds each. Andrew, 2020 has been a game changer for all of us. I just want to hear personally, how have you found 2020 and trying to do your job? 30 seconds. Just tell us about your personal experience of doing your job in 2020.
There's no substitute for face-to-face meetings. So as of November, I started traveling again. And I've been to Kenya, I've been to Cameroon, I'm going to Nigeria next week. I've been onto 10 construction sites in the last 7 days. And what you can achieve on with face-to-face meetings in Africa, and unfortunately, digital has been great to keep the fire going, but you can't really move the needle. And Africans need to feel you, touch you. We need to suss each other out. And so 2020 has really been a 3-month year. It's only as we've been able to open up and really start traveling that you've really seen the ability to move the needle as such. Otherwise, it's been quite stationary.
Thank you, Andrew. Thanks, Andrew. Ramsey, just a few seconds. How have you found 2020 trying to do your job?
No, I think, look, I mean, the challenge of travel is one, but I think for me, the biggest learning is really working as a team. And that is at every front level, not only us as a development team. And obviously we're a few of us in Radisson, but, you know, with your commercial team, with your operational team, maintaining resilience, maintaining, you know, some sense of confidence. And I think, you know, we are the ambassador of this industry more than anyone. So we need to stick with a certain sense of solidarity as a team. And that is beyond Frontier. This is beyond, you know, companies. And I think that's what we're trying to achieve, and maintaining a constant confidence. Yes, you're right. It's going to take some time, and we do not project things to come back to 2019 before 2023, but we need to have this optimism, and we need to work towards, you know, that optimism in terms of vision and objective all forward and all together.
Ramsey, thank you so much for joining us. Andrew, thank you for joining us on your hectic schedule in the cafe at OR Tambo. Did you see the guy behind you waiting to take your order earlier? No, you didn't, obviously. So thanks, Jen. Thanks. Good session. Thank you. I've enjoyed it. Thanks very much indeed.
Thank you.
Cheers. Thank you. Cheers, Ramsey.
Bye.